Good morning once more, team.
Morning, coach.
Morning. Today's class will look at the profit and loss, obvious group profit and loss, or what you call statement of profit and loss and other comprehensive income. That is what we'll look at. Then tomorrow we'll look at a very short topic on IFRS 11, which is on joint ventures. Then we'll go into complex groups. Okay. I think last time I asked this question on, if anything, it was an example that I'd given on Luke. Why I was saying, Luke borrows, say, 50 rands from the wife. And the total, does the wealth of the family changes after he has borrowed? So I think what we discovered was that it doesn't change, so it remains as is. So, and I still ask the same question here. It says, Mr. Banda, who has a net worth of 5,000 kwacha, borrows a 50 kwacha from the wife with a net worth of 2,500 kwacha. How much is the Banda family worth? So we know that the amount is not going to change. It shall remain 7,500. Isn't it, Victor Luke?
Yes, that's it.
So we are looking at, let me do this. So the rule in the group accounts is that all the intra transactions must actually be cancelled. And it's just stemming from the example that we have actually given, that you are considered as one at some point. Yes, you may be individual or separate companies, but at group accounts, at consolidation, you will be considered as one. So any intra-dealings amongst yourselves, that must be removed or cancelled. So let's just imagine one thing here. And these are basically real life business activities. Goods come into the group at $1 each, gets into company A, which this company may be the parent company or subsidiary company, any of the two, doesn't matter. Then company A sells the same goods for $15. The group at cost, the cost is $10 each, and sells the goods for $15 to company B, which is actually part of the group. So with company B, in the books of company B, sorry, it shall be recorded as a cost of 15 kwacha each. But in the books of company A, it shall be recorded as sales. Then company B sells the goods to the outside, what we call the outside world, at $20. So if we want to do the consolidation, we'll need to make some necessary adjustments on all those intra transactions. One, we shall debit the group sales this. We shall actually debit it somewhere out here. We shall debit it so that we reduce the sales by that intra value. Then we shall credit the group purchases from here, the 15, so that we reduce the cost of sales. So at any given time, whenever you have these intra transactions, first thing that you have to do in the income statement is to make necessary corrections, meaning that you cancel out all the intra transactions. Mm-hmm. So we look at the consolidated statement of profit and loss and other comprehensive income, and how we should be in a position, or how we should actually consolidate the two income statements. That is for the parent company and for the subsidiary company. For the parent company, we know it's no brainer at all, because we'll get a whole 100%. For the subsidiary company, it entirely depends. Let me do this. So from the parent company, so from the parent company, we'll get all what is in here at 100%. Then from the income statement, we'll only consolidate anything post acquisition. And these income statements, we know that they're annual. The assumption here is that the profits generated, all business transactions that have been accounted for in the income statement, are assumed to be incurred or earned evenly throughout the year. So then now it brings us to the concept of pro rata, meaning that actually, if it's say in June or maybe July, we'll assume that the first 6 months before acquisition, we shall divide all the transactions by 2. The only thing we cannot do is to do our pro rata thing on revaluation, because like say one of us that it comes in at the end of the year. So we cannot do the pro rata on this one. But all these other elements, we will need to do the pro rata, or we need to prorate them. So get by 2, we'll make some adjustments. These adjustments, basically, they are on issues of the intra that we have looked at already. So we'll pick them as is, divide them by whatever, based on the month in which the acquisition was done. Then whatever amount we get here, say for example, we get 200. For example, we get 200. And here maybe, let's say we have 400. And we are actually told that our stake is maybe, let me say, 75%. So the thing that we are going to do, whatever consolidation that we have, say there, which is 600, 600, we'll get a 25%, which will come and sit here at 50. So the balancing figure, that is what will be attributed to the parent company. And in this case, we are actually going to have 550. So if there will be any impairments that will be made, say on goodwill, that has to be accounted for as well. So let's look at the question. I don't know if you are clear here, but let's just look at the question. I give you some tidbits, then you can work on it. So the question reads, the following information is relevant in the preparation of the group financial statements. On 1st July 2017, Kavamba acquired 80% of the equity shares of Mninda, a public limited company, for a cash consideration of 90 million. The fair value of the identifiable net assets acquired was 85 million kwacha, and the fair value of the non-controlling interest was 25 million kwacha. The fair value of the net assets at acquisition was not materially different to their book value. So what does the examiner want here on this part? What does he want you to do?
Doesn't he want us to calculate goodwill?
Yes, he wants you to calculate goodwill. The last statement, what is he trying to tell you?
That there won't be any revaluation.
Yes, basically you pick what is in the books. Because there is no major difference between the book value and the fair value.
Yeah.
Then on 1st January 2017, Kavamba acquired 25% of the equity shares of Catalina and exerted significant influence through its representation on the board of directors. Catalina's profits for the year were 100 million kwacha. What is it trying to tell us, or what is she trying to tell us?
That we have an associate there.
Yes, we have an associate, and any amount, any profits due to Kavamba will need to be taken care of, which will come here.
Mhm.
Where? Which will come here. Okay, this is the impairment, which will have, yes, on the revaluation. You can have your profit somewhere even here. You can have your profits even here. Mhm. Mhm. Or actually, basically, the investment income to come here.
You will need to split it.
No, okay, here basically you will do your evaluations, whatever you can do.
Okay.
You can just bring it here, it's fine. Okay, we'll look at it in details. Mhm. Then we're told, okay, it is group policy to measure the non-controlling interest at acquisition at fair value. Goodwill has been impairment tested at year end and found to have fallen in value by 20% in Karamba. Goodwill impairments are recorded in administrative expenses. So what it means here is that whatever goodwill you're going to get, Victor, compute your 20% and take that 20% as an expense into the administrative, under the administrative line, because that will be an impairment. Mhm. And you know that goodwill is a balance sheet item. So the only thing that you're going to do there is just basically on the impairment, which is going to be recorded in the income statement. The rest goes into the balance sheet. Karamba sold goods. Karamba sold goods to Munyinda for 20 million at fair value. Karamba made a loss on the transaction of 5 million, and none of the goods sold had been sold outside of the group by year end. So we have a loss here. What do we do with this loss? A loss, ideally, you just record it immediately. You cannot share, like our president always says, that you cannot share poverty. So the moment you see a loss, recognize it immediately. So we'll look at how we treat that. Munyinda revalued its land and buildings at the end and recorded a revaluation surplus of 50 million through other comprehensive income. Yes. So here, all these, you are going to prorate them, and you take into consideration whatever interest that you have. This, please do not prorate it, because this revaluation is actually done at the year end. So there is no need to do to prorate it based on when you acquired the company. There is literally no need. We'll do it together, definitely. Prepare a consolidated statement of profit or loss for the Karamba Group for the year ended 31st December 2017. So what I want you to do is you are going to share your screen so that you just discuss over the goodwill computations. Then from there, because I think the major computation here is just on goodwill. The rest is pretty easy. So Have you, Luke, I'm sure you have downloaded the PowerPoint. You can just, let me just give you some right to share it. Have you downloaded this? Luke or Victor?
Oh, you said you sent it on email.
Yes, yes, yes.
Let me
No, I
download.
haven't. My laptop.
Okay, just download it. Download it. So on admin expenses, what did you do on admin expenses?
We adjusted for the loss in goodwill impairment. Or does it supposed to have its own line?
How do you subtract impairment when it's supposed to be a cost? Because what you have
Was
done
it
is that
subtracted?
on your goodwill,
We added it.
You had the goodwill.
We added it.
Eh? What was added?
We added it. We added it.
Okay, let me just.
Because this is the adjustment there.
Okay, so you have 90 plus 0.5, how much you get?
115.
So plus 6, it takes you to
121.
121. Okay. Then profit before interest and tax, what happened there? Okay, so we have the finance cost, investment in associate. Just explain to me what you did. You had the 100 times 25, right?
Yes. That's what we do.
Okay, just go up.
100 times 25.
Yeah, okay, it's fine up to there. Then taxation. There's something that you haven't adjusted nicely. That's 6 out of loved the 6 from the impairment. You see in line 10. As much as we know that that impairment is supposed to be absorbed in the admin expenses, maybe we could have created a row just below the admin expenses, which would have called impairment. But we know that impairment is going to be part of, so that we have it in line F to adjust your TCI. Your 106 is supposed to be about 100.
Oh, okay.
You're saying like this?
Yes. Then you can have your 6 there. Your
in line F.
If you want, you can just say equals, then you pick that 6 that you have in line 10. In G10, equals, then pick that. So no, don't adjust it the other side, otherwise you double count. I don't know if you're seeing what I'm trying to do.
Oh yeah.
Because you have already counted it in G. All you're trying to do, you want to have a correct number in F.
Okay.
Okay. Yes.
That's it.
All right.
Okay, that's it. Okay. Yeah, okay, this is okay. This is okay now. Congrats, this is okay. On the parent, the NCI, you got your 20% of the 100 from the subsidiary. Then the difference is attributable to the parent company. That is it on the group profit and losses. Okay, you can stop sharing if it's okay. Then we continue with the other two components that are as you part of our inventory.
Coach, if there was a dividend, how are we going to treat it?
We're going to make adjustments because if it's a dividend, where is it going?
Okay.
And so we're actually going to, because there's dividend received and dividends paid.
All right.
Yeah, but we're going to make adjustments. We're going to subtract the dividends paid.
All right. Okay, that's fine.
Okay, so we look at IFRS 12, which basically looks at the disclosure of interest in other entities. It requires that the parent discloses the significant assumptions and judgment used in determining whether control exists over an investment. So they have to bring in their judgments, they have to bring in all assumptions and make us know whether they have control in a particular investment. So the parent will therefore list all the entities he has a relationship with and explain the basis of the accounting treatment. So they will list if they are joint ventures, they will list and say these are joint ventures, these are associates, these are subsidiaries. And the only way you can see this, if you want to see it in a very practical way, you can still go on ZESCO website, go to financials, integrated reports, and pick the latest integrated reports. You will see that on the last pages of that document, they actually list the joint ventures. They also list where they have, in whichever institution, in whichever organization or company they have interest, they actually list and show that particular relationship. So you can see it from a practical point of view. It's under, these disclosures are actually guided by IFRS 12. And these things, you need to know them. In case the examiner actually asks a theoretical question on IFRS 12, you'll be in a better position to explain it because in there, you're only looking at the disclosures of interest in other entities. Then we also have impairments and the group accounts. We're saying an asset or SGU is impaired if its carrying value falls below its recoverable amount. Let me give this example. The carrying amount, say for company A, is 20, and that is what is the balance sheet. Yet the recoverable amount is, say, 25. So whenever the carrying amount is below the recoverable amount, then you know that there is an impairment that has been done. So what is the guiding principle here? You have the recoverable amount. So how do you determine which one is the recoverable amount? There are two things. You have the value in use and the fair value less to sell. So any of the two that is above, that is what you pick so that you are able now to compare with the carrying amount. The carrying amount is what is in the balance sheet. So what value is in the balance sheet against what you have picked between the two. the fair value less cost to sell, and the value in use. These will be clear when you start now looking at the IS36. They'll be extremely clear. We may also have these subsidiaries or impairments. They're saying the subsidiary is treated as a cash generating unit where the carrying value is that of the subsidiary plus any goodwill. So let's look at the examples. We'll try to do them quite easily and quickly. Let me pick. Subsidiary impairment. Tendai acquired 60% of the equity share capital of Mwape on 1st January 2021 for 20 million. So we know that we have the fair value here of 20 million. The fair value of the identifiable net assets at that date was 25 million, and the fair value of the non-controlling interest was 15 million. So we have the NCI of 15 million, which gives us 35. Then we have the net assets at the time of acquisition, which is 25. Is it 25?
Yes, 25.
So giving us goodwill of 10. Goodwill. So Mwape made profits for the year ended at 1st December 2021 of 5 million. So here first we want to establish the carrying amount. So the carrying amount will have the NCI, the net assets at acquisition, which is 25, right? Oh, sorry, let me just speak this one. Hello, yes, Martha. Can I actually the console? That's a play. Matambula this month. Okay. You might say, may not saving and you might go saving. Okay. Sorry, guys, just a bit. Sorry, I'm distracted a bit. Okay, sorry guys, I was a bit distracted. Let's just finish up this. So we are saying that the carrying amount will be the net assets at acquisition plus goodwill plus what? Plus the profit. Mwape made profits for the year 31st December 2021 of 5. So giving us a goodwill of how much? Or giving us the carrying amount of 40. Do you agree with this?
It's net assets plus goodwill plus profit of 5 million. Yeah.
Net assets at acquisition. Then you have the goodwill. Then you have your profit. That gives you your carrying amount. Is it okay? Or you need further
Yes,
explanations? In short, Victor, do not get confused. In short, this is basically it's basically your accounting equation. All you are saying is that you have assets. Apparently, these are the assets that you had at the time that you are acquiring the company, plus profits.
Yes. Plus goodwill.
Plus goodwill. This is now what is going to sit in your financials as carrying amount. So we have the 40 here as carrying amount. We want to see whether there was any impairments whatsoever. We are told that its value in use, VIU, sorry, its value in use is 38. And we are told the fair value less cost to sell is 36. The standard says we pick any of the two which is high. In this case, we are going to pick 38. That's a value in use for your company. That's a value in use. But what is sitting in your balance sheet is 40. Yet it was supposed to be 38, meaning that your balance sheet, your carrying amount, I think this is what I wanted to say in terms of the impairment. The carrying amount is higher than the value in use.
The value in use.
This value in use now, it changes. When you pick any of the two, this is what you're going to call as a recoverable amount. So we're saying if we're to recover, if this thing was to get bent and we want to recover, or want to recover the current assets that we have, we can only salvage 38. Yet what is in the balance sheet is 40. Or what is on the balance sheet is 40. So, in short, it is overstated by 2. Therefore, we need to carry a test of impairment. And the 2 will be the 2 million, which will be the impairment. Meaning that this 2 million, because now it's an expense, it will go to P&L. Is it okay? Hello?
Yes. Yes. Okay.
Yes, it's okay. It's okay.
Okay. Mhm. So then now we go to so still on impairments. That one was on impairments on the subsidiary. Now we go to the impairment on the associates. Same concept. The associate is treated as an asset. The associate is treated as an asset where the value of the asset is the value of the investment in associates. And we know when we check in the balance sheet, it comes just after under non-current assets. We have the cost of investment. So we know that this is where our associate is going to sit in the balance sheet. And whatever profits that are attributable to us, based on the investments that we have put in a particular associate, that will come just after the finance cost. So that we are clear, it's fair play, we have no problem with it. But then how do we do our computations on impairments for the associates? The concept is still the same, but we only pick a portion of what is attributable to us. Let's check on the example. Banda acquired 25% of the equity share capital of Ndlovu on 1st January 2021 for 5 million. And exerts significant influence over it. So we know that there's a 5 million. Ndlovu made profits for the year ended 31st December 2021. Ndlovu made profits for the year ended 31st December 2021 of 2 million and did not declare any dividends. So we know that there were some profits of 2 million. So of this 2 million, we calculate 25% of this. How much we get?
It's 500.
So we'll have 0.5 since we have raised the million up there. Giving the carrying amount of how much? Or 5.5.
5 plus 5, yeah, 5.5.
Yeah.
So this will be the carrying amount. Then Banda impairment tested in Ndlovu at the end of the year, whereby the fair value less cost to sell were 16 million. So the fair value less cost to sell or 16 million. So 16 million times your interest or 25% Then value in use. Value in use is 20 million times 25%. So here, 16 times 25, guys, how much is it?
4.
4.
It's 4.
Then this is 5.
5 there.
5.
So from this, which ones do you pick
The value
as,
in use.
You pick the
as
5.
value in use, as recoverable? As recoverable. So what would be the recoverable amount?
5.
It will be 5.
Mm.
Mhm. So here now, what does it mean in terms of the impairment? You have the carrying amount of 5.5 minus the recoverable amount of 5. What is the carrying? What is the impairment? The impairment will be 0.5, right?
Yeah. Yes.
Very interesting concepts. Mhm. Then you ask, calculate the value of Ndlovu. The value of Ndlovu is 5, right? That will be the value of Ndlovu. It's the recoverable amount. Are we there?
Yes.
Because remember that the carrying amount was higher than the recoverable amount. So this is how it is. Let me do this. Let me do this, guys. Here, the point first, what you have to do when you're looking at these impairments. So first thing, So the first thing is to, I'll say, determine guys, don't get worried. There is a new group that is joining us. This will be done by 10. It's a group of students. I assume that they're from South Africa, but they will introduce themselves later on.
Okay.
Fezile will be done soon, and I'll attend to you and the team. Okay. So the first thing that you do, you determine the carrying amount. Will be done in the next 2 minutes. Just watch. Maybe you have something to learn as well. So determine the carrying amount, what you see in the balance sheet. And here we have actually said, how do we calculate, how do we determine this carrying amount? One, we first find the net assets at the...
Hi, Patrick.
Fine, how are you?
I am well, thank you. I'm gonna open my video.
Please, please, please.
So you can see who you're talking to. I'm not a robot.
Oh, yeah.
Thank you for taking your time to really talk to us. I'm trying to open my video. Okay, there we go. Hello.
Okay, I'll be done with them in the next 2 minutes, so you can just hang around. I'm just summarizing. Good to see you. Yeah.
Thank you. Thank you.
Sure. So first thing is to determine your carrying amount. And this carrying amount, I said, is the net assets at acquisition, plus goodwill, plus any post acquisition profits that you're going to generate. The second thing is to determine what is recoverable. Here now, you're looking at recoverable amount. So you have two elements. You have value in use, and you have fair value, less cost for sale. So any of these that is high, that is what you're going to pick. So if you find that the carrying amount is higher than your recoverable amount, then you have a reason to impair. We'll be looking at these things as we go into IS 36. So for today's class, we are done, but as usual, Victor and Luke, you have to check out, just like being in the hotel. After you've spent 2 days or 3 days, you don't just leave the reception, you have to do your checkout. So Luke, today's class, what are you saying?
Before we go there, Albert, if for this one, if the carrying amount is lower than the recovery, what did you say?
Thank
if
you,
the
thank
carrying
you,
amount
thank
is
you.
lower than
Thank
the
you.
recoverable amount.
Thank you. So if you find that the recoverable amount, then what it means that your assets have been understated. The capacity in which your assets generate value is higher than what is being recorded. What do? You revalue, and you revalue upwards.
Okay.
Because whatever you're doing in here is just basically revaluing. Are you revaluing going down, or you're revaluing going up?
All right.
Thank you. So you can do your checkout, Luke.
Thank you, Coach. Enlightening, and the way you put it across makes it easy for me to get the basics, which basically which will assist me when I look at any a question that I come across that have the same, that I have to apply the concept on, or the same concepts on. But I think it was enlightening. I think if you can give us another class example that we can work on, maybe later on today, if you can.
Okay, though you haven't done my good way of questions, those 3 questions,
no,
I haven't seen anything.
Okay, I'll have to just send them to you. I did them late last night.
Okay, thank you.
Yeah.
Victor?
Yes, it is, like Luke says, enlightening. For me, it's when you're studying, there is the training side, but for me, it's the pictorial view that I'm getting. So you see, with these things, when I see a question, the picture is in my mind, so it's easy for me to interpret. So I'm getting it. And I'm liking the way it's going. Apologies, I haven't done the questions but it was busy at my work after the holiday. So today I'm free. I'm gonna do them this afternoon and then send to you the good questions.
Yeah, thank you. And just for in practice, the way we calculate this value in use, I've been involved in doing the financial models for ZESCO, and because at any start of the audit, the auditors will request that wherever, based on IFRS 12, whichever subsidiaries or interests where ZESCO or companies where ZESCO has an interest will actually need to do the impairment testing. Now, being the financial modeler there, obviously I'm a chief financial analyst, but I do a lot of financial modeling. We go for all the companies. I think there are about 4 or so companies where we will have to prepare valuations, 5-year valuations, and in perpetuity for each company. But the method that we normally use is the discounted future cash flow, so that we're able to know how much cash we're going to generate and discount it today so that we make a decision. So we will use that to calculate the value in use and do just calculate the value in use. Then compare with what is in the balance sheet, then you'll be able to see. Because there are times when we have assets, and most in these business schools, sometimes they get it wrong. They look at the value of the asset value of the company and come up with the value, the total value of the company, but it doesn't work like that. You may have a company that has a huge asset base, but unfortunately, this company is keeping what we call as assets. These are assets that are not able to generate meaningful revenues or cash flows. There are a number of reasons why they will not generate meaningful revenues. One of them, it could be that, yes, you have invested in capacity, productive capacity, but the demand of the products that are coming from this particular company is quite low. So why can't you just value it based on what it is able to provide or what it is providing, not what you think it can potentially provide? So we normally do these future cash flows and calculate the value in use, then compare with what is in the balance sheet. So you'll find that if you are over investing in asset base, IAS 36 will demand that you do your impairment so that you marry your future cash flows to your asset base. But then it also gives you an understanding on whether the company is over investing or not based on that particular standard. I know it will be interesting when we go to that standard. When I teach you on, or maybe explain on the IAS 36, it will be quite interesting because I'll use a lot of practical examples based on what I do the other side. Thank you so much. Luke and Victor, you can leave us now. I'm joined by a new team.
So we meet tomorrow, 8 o'clock, 8 a.m. tomorrow?
Yeah.